Imagine you're sitting in a quiet room, a screen in front of you filled with charts of stock indexes, exchange rates, interest rates. Everything looks normal. Then you look up at the title of this video: 1997 Asia, 2008 Wall Street, 2025 China US. Are we sleepwalking into the next financial collapse? And you start to wonder, are we walking straight into another global financial crash without even realizing it? Financial history has a very annoying habit. It doesn't repeat exactly, but it rhymes. 1997, East Asia, 2008, Wall Street. Every time, people said, this time is different. Every time, it turned out, not that different. And now, as debt, bubbles, monetary tension, and strategic rivalry increasingly orbit around the China-US axis, the real question isn't will there be a crisis? It's what will it look like 1997, 2008, or some ugly hybrid of both? Let's go back to 1997. Back then, Asia was the rising star. Thailand, South Korea, Indonesia, Malaysia were praised as the Asian miracles. Growth at 7 to 10% a year, foreign capital pouring in like a waterfall, real estate rising like mushrooms after rain, stock market surging. Media, investors, international institutions all believed. This is the Asian century, the historic shift of economic power from west to east. But what was under that glossy surface? A very familiar model: borrowing short in foreign currency to fund long-term investments in local currency. Local banks and corporates borrowed dollars and yen at low interest rates, then lent domestically in local currency at higher rates, assuming the exchange rate would stay stable. Governments fixed or softly pegged their currencies to the dollar to project stability. Everybody believed no one would dare attack a region growing that fast, until the flow reversed. In July 1997, Thailand was forced to float the baht after burning through its foreign reserves defending the peg. The speculative attack succeeded, the baht collapsed, and the entire borrow in foreign currency, lend in local, peg to the dollar system blew up. Dollar debt exploded in local terms as the currency fell, while assets, real estate, and stocks crashed in that same local currency. Bank, corporate, and household balance sheets were torn apart at the same time. Panic jumped from Thailand to Indonesia, Korea, Malaysia. Foreign capital didn't just stop. It rushed out. In roughly a year, economies that had been held up as models of sustainable growth plunged into deep recession. Bankruptcies, unemployment, and social unrest spiked. The 1997 crisis wasn't just a story about exchange rates. It was a classic lesson in sleeping on a pile of cheap hot money while ignoring currency and maturity mismatches. Now jump to 2008. This time, not Bangkok or Jakarta, but New York. The epicenter isn't emerging markets, but the most powerful financial center in the world. Wall Street is in the middle of a long intoxication. Housing prices always go up. Everyone deserves a home. Low rates stay forever. And high leverage is called capital optimization. The core of the 2008 crisis wasn't real estate. It was promises. Millions of mortgages were bundled into securities, stamped AAA, and sold around the world to yield-hungry investors seeking more than plain safe bonds. Risk models said the odds of mass default were tiny. Investment banks believed the models and dialed leverage up 20, 30 times. As long as house prices didn't fall everywhere at once, the machine would keep humming. But house prices did fall. And when the collateral cracked, leverage became a losses amplifier. Short-term money markets froze. Banks stopped trusting each other. Too big to fail suddenly became too interconnected to rescue cleanly. Unlike 1997, where emerging markets had to beg the IMF, this time the IMF mostly watched while major central banks pumped liquidity, cut rates to near zero, and launched unprecedented quantitative easing. Sound familiar? 1997 was hot foreign capital plus currency pegs, plus borrowing in dollars, lending in local currency. 2008 was extreme leverage plus complex collateral plus blind faith in risk models. Both shared the same DNA, extended periods of cheap money, the belief that this time is different, and an eventual breaking point that forced policymakers into emergency, extreme measures. So in 2025, if we look at the world's financial map, where's the red zone? The answer is increasingly clear. Along the China-US line, China stepped into the 21st century with a very different model. Cheap exports, massive infrastructure investment, rapid urbanization, a banking system heavily directed by the state. The results were staggering. Hundreds of millions lifted out of poverty. New megacities, high-speed rail networks, bridges, ports, airports everywhere. But what was the price? Debt, both visible and hidden debt. Local governments borrowing through financing vehicles. State-owned enterprises piling on leverage. The real estate sector turning into a giant store of value, where millions of apartments were built not just for living, but for packing wealth. For more than a decade, Chinese real estate was growth engine, collateral, and speculative asset, often all at the same time. The property-related share of GDP was estimated at over 20 to 25% in some periods. When that model began to stall, an aging population, slowing real housing demand, tighter rules on property financing, giant developers started to wobble. Their bonds were sold off. Countless projects were left unfinished. Homebuyers began to lose faith, even boycotting mortgage payments on uncompleted developments. This isn't a carbon copy of U.S. housing in 2008, but it's a close cousin, an economy heavily addicted to construction, credit, and the assumption that asset prices only move one way. Meanwhile, across the Pacific, the U.S. entered the 2020s with a different inheritance. Record peacetime public debt, rates that had been too low for too long, and massive stimulus packages after the pandemic. Public debt soared well past 100% of GDP, and interest costs started to eat a bigger slice of the budget. Rates had to rise again to tame inflation, and suddenly the world of zero rates, free money, that Wall Street had grown used to for over a decade vanished. But America still holds one trump card that Asia in 1997, Europe in 2010, and many emerging markets never had. The dollar is the dominant reserve currency. That means when risk spikes, capital still runs into U.S. treasuries as a safe haven. The issue isn't, will the U.S. go technically bankrupt, but when will markets begin repricing the risk of a country that both issues the global reserve currency and runs persistent twin deficits budget and trade, while rolling over enormous volumes of debt? See the pattern? 1997, foreign currency debt and fixed pegs. 2008, financial leverage and complex collateral. 2025, on one side China with swollen domestic debt, property exposure, and an investment-heavy growth model. On the other side, the U.S., with huge public debt and a reserve currency status under slow, subtle test. Both are tightly wired into the global financial system. If either one slips, the shockwaves won't respect borders. So what does sleepwalking mean here? It doesn't mean nobody knows the risks. The reports, research, data, and warnings are everywhere. The IMF, the IS central banks, economists all talk about debt, asset bubbles, systemic risk. Sleepwalking means we know, but we act as if time is unlimited. Governments keep buying time with new debt. Markets keep believing central banks will always rescue in time. Individuals keep assuming a bad day will come, but probably not this year. Compare today's risk structure with 1997 and 2008. In 1997, the key risk was short-term foreign debt and insufficient reserves. That lesson pushed many Asian countries to build huge FX reserves and reduce dependence on short-term foreign capital. Today, they're much harder to attack the old way. But that doesn't mean they're immune to all shocks. In 2008, the risk was in the shadow banking system and complex securitized products. Post-crisis, regulations tightened, capital ratios rose, models were adjusted. But risk migrated elsewhere. Hedge funds, private credit, corporate bond markets, fintech platforms, and yes, China's own shadow banking networks. China's risk has its own style, a blend of state planning and market elements. When things are good, that mix allows for fast, decisive interventions. When things go bad, those quasi-official, quasi-market channels, wealth management products, local government financing vehicles, cross-guarantees among SOEs can form a domino chain that's hard to map. Once faith in the state's ability to always stay in control is seriously challenged, the urge to move money out via legal and not so legal routes can accelerate brutally. The U.S. faces a different danger, the risk embedded in privilege itself. When you issue the reserve currency, it's easy to believe you can always borrow more, print more, and markets will accept it. That remains true until it starts to be less true. Not with a dramatic global boycott of the dollar, but through years of quiet reserve diversification, contract terms that no longer default to USD, and countries actively trying to reduce dependence on US-centric payment infrastructure. So what might the next collapse look like? Most likely it won't be 1997 or 2008, but a composite. Picture a sequence like this. In China, the property downturn drags on longer than expected. Local governments choke on debt. Banks quietly restructure and recapitalize or receive hidden support. Growth slows for years. Youth unemployment remains high. Household faith in real estate as a safe store of value breaks down. Money looks for ways out through official channels and underground ones. At the same time in the US, interest rates stay relatively high to keep inflation under control. The government's interest bill climbs, political fights over debt, and budgets get nastier. Markets start demanding a higher risk premium, especially at longer maturities. Every confrontation over debt ceilings, shutdowns, or political instability triggers spikes in yields. Emerging markets, which borrowed heavily in dollars during the low-rate decade, feel increasing strain. Then a shock default at a giant Chinese developer, a US fiscal crisis, or a geopolitical flare-up that spikes commodity prices hits fragile confidence. Capital reprices. Some corporate bond markets freeze. Some banks or non-bank financial institutions expose just how leveraged they really are. Economies deeply tied to both China and the US, through trade, supply chains, and capital flows, get squeezed by two storms at once. You might think, but central banks have way more tools now. They can pump liquidity, cut rates, intervene. True, and that's part of the problem. Everyone has grown used to the central bank as ultimate savior. Markets assume there will always be a bailout program, a new asset purchase scheme, some tool. The real question is, at what point do central banks themselves get trapped between two roles fighting inflation and saving? The system where any decision is a painful trade-off. Are we sleepwalking? Look at behavior. In 1997, the belief was, foreign capital will keep flowing because of the Asia story. In 2008, the belief was, US house prices will never fall nationwide at the same time. In the 2020s, the beliefs are, the dollar will always be king. Beijing will always get domestic risks under control in time, and central banks will always step in before the cliff. Those are all reasonable. Until they aren't. None of this means a global crash is guaranteed next month. Financial history doesn't work on countdown timers. But it does send signals constantly, through the structure of debt, through how markets price risk, through the behavior of capital flows. If we only watch breaking news and ignore deeper currents, we really are walking in a dream. So what should a normal person, a small investor, a curious observer of financial history take away from all this? First, see the world in cycles, not just shocks. 1997 didn't come from nowhere. It came from years of building imbalances. So did 2008. Any future crisis tied to the China-US axis will also be the result of a long chain of decisions, trends, and habits. Second, understand that debt is always central. Whether it's foreign currency debt in Asia, mortgage debt in America, domestic leverage in China, or public debt in the US, the common denominator is promises to pay in the future. When those promises grow faster than real value creation, markets eventually force adjustment. The adjustment can be inflation, default, devaluation, or a mix of all three. Third, never underestimate trust. A banking system can operate for a long time in a state of technical illiquidity as long as trust survives. A currency can remain the primary reserve unit even as debt numbers worsen as long as there is no better alternative. But when trust flips, flows move faster than any model expects. Finally, financial history isn't there to make you panic. It's there to make you awake. 1997 taught emerging markets about foreign currency debt and hot money. 2008 taught developed markets about leverage and model illusions. 2025 and the years after will teach the whole world something about China, the US, money, debt, and power. We don't know the exact lesson yet, but we already know one thing. We don't get to say, no one could have seen this coming, because history has already screened this movie for us more than once. If you want to keep decoding the patterns that repeat in financial history, from Spain's Silver Empire and Britain's peak pound era to the dollar and the ambitions around the yuan, stay with this channel. Every time we think we're walking a road no one has walked before, chances are some empire, some market, some generation has already been there and left very clear footprints in the sand.